Hello everyone. Today we discuss another chapter in financial management, chapter 11, by the topic of investment decision criteria. So towards the end, the learning objective would be one to you should be able to understand or how to identify the source and type of profitable investment opportunity. Okay, second one is you also have to be able to evaluate, this is the keyword, evaluate investment opportunity using NPV, net present value, and describe why net present value will be the best measure to use. Okay, and you also in this chapter also we discuss another method of looking the company's opportunity or investment evaluation by using one is profitability index. Okay, this would be number 2 on top of the net present value. Number 3 is using the internal rate of return, okay, or also known as IRR, and using payback criteria. This is another criteria, okay, payback criteria. So there are 4 basically method of how company assess their investment or capital expenditures process. And finally, you should be able to understand what is the current business practice with respect to capital budgeting criteria. Okay, let's first look what is actually a capital budgeting. Okay, so if you go back to the balance sheet of the companies, so we have on the right side the liabilities and equities, while there are asset on the left side. This is your total asset. Okay, but asset could be divided into 2, which is the current asset, okay, and fixed asset or long-term asset. Okay, long-term asset. So basically a capital budgeting is a process where the company buying or invest in long-term asset. Long-term asset. So any process that involve a decision in this item under long asset is considered as a capital budgeting process. So example of long-term asset here is perhaps plant and machineries. Okay, plant and machineries, maybe some land and building, and so on and so forth. So when it comes to deciding, okay, or assessing either the company may want to buy or acquire additional plant and machineries or land or building or any item under long-term asset, that would be considered as a capital budgeting process. Okay, further details of what could be fall under capital investment or capex, capital expenditure, also known as a capex, is example 1, revenue enhancing investment, such as if you are introducing new product line. So it means maybe if the company is buying a new set of machines, that we'll consider as revenue enhancing investment. So whatever machine that you're going to buy will be parked or will be recorded under a long-term asset. Therefore it requires an assessment, because that type of investment would involve a long-term use of fund or money. Okay, another types of capital investment or capex is a cost reducing investment, such as replacing all new equipment, or maybe involve a mandatory investment, okay, that result government mandate, as a result as a government mandate, a requirement by the law. So the company, what is important is that capex will involve a purchase or investment of item that will be categorized or recorded under long-term asset. Okay, if we review the slide before, there are basically four methods of capex assessment. One is the net present value. If you can remember, the method is NPV. There are also EAC, equivalent annual cost, also IRR, and payback. Okay, payback. Let's just discuss about the first capex assessment method, which is known as net present value. Okay, so net present value is basically the difference, okay, between the present value of cash inflow and the cash outflow. So NPV basically estimates the amount of wealth that the project creates. So it's basically about what is the cost minus the future inflow expected from any specific capex that you are considering. Okay, so when you are using net present value, the decision criteria is that investment project should be accepted if the NPV of the project is positive, means that the inflow, the future inflow, okay, should be more than the cost outlay of the that project. Okay, so so consequently the project should be also rejected if the NPV is negative. So class, the NPV, if you can remember the chapter on time value of money, so basically the principle of NPV is similar to the time value of money. So in fact, all the decision criteria under CAPEX, under this chapter, is using a theory of time value of money, due to the fact that CAPEX involved in deciding the use of money or the use of your fund for long term. So we can visualize, in fact the NPV is basically a process of where company making an investment here and expecting a inflow in the future. So if you talk about for example, if the company invest in one machines that have maybe 1 or 3 4 5 years of life expense. Okay, so under NPV, what happens is that we want to look at either the inflow, the future inflow of acquisition of this machine would justify the cost of machine of using buying the machine during year 0. Okay, so basically what happens is that, say we invest 10 million here. Okay, so in expecting that the machine will provide, say um, 3 million 3 million inflow every year here throughout their life expectancy of the machine. We want to identify if this investment of 10 million is profitable. So what happened under NPV, basically that we're gonna calculate the present value of all the future cash flow and minus the capital outlay. Yeah. So the idea is that all these future inflow should give more than the cost of the machine. If we calculate the present value of this future inflow. Okay, so that is the basic idea of NPV. Okay, now let's look at the sample of the problem using NPV. Okay, in this case, Saber Electronic provides specialty manufacturing services due to defense contractor. So the company Saber Electronic um, would invest 3 millions, and the company generate cash flow throughout 5 years. 5 years. So the company used 20% as a discount rate. So if you are using NPV methods, this is basically you can just draw the timeline of this project, time 0, 1, 2, 3, 4, and 5. Okay, so there's an initial outlay of 3 million. Okay, so means that during 0, 3, 0, 1, 0, excuse me, 0 year, there will be negative 3 million. So this is the cost of the project, and there will be a series of future inflow. There will be 500k here, another 700k here, 1.5 mil here, 2 million here, 2 million here, and another 2 million here. So under NPV, what happens is that you want to discount everything here, going into this year 0. Here. So we want to have a positive net present value in order to accept this capex capital expenditure plan. So if you look at the solutions, after plugging all the numbers in the formula, so you get the NPV of 570,000, 73,000. So it is a positive NPV. So we can conclude using NPV method that this project that require initial 3 million, that is the negative 3 million during year 0, will generate a future cash flow that have a present value of 3.573 million. Okay, so if you minus that things, this figure, so you get a positive cash flow of 573,000. So basically that is more than this one. This is more than the amount of 3 million initial capital outlay. So since the NPV is positive, then using NPV method, we will accept this project. When the company considering capex or projects, the projects can be categorized into two categories. One is the independent, investment project, and the second one is a mutually exclusive project. So what is independent investment project? It means that is a one that stand alone and can be undertaken without influencing. Means that, say for example, the company is considering 2 or 3 projects at once, and this is an independent investment project. Means that you can, or the company can, accept all those projects as far as the project fulfill the requirement on the capex investment assessment. So means that if you are using NPV method, so all the project under independent investment project can be accepted as long as the projects has a positive NPV. So the other category, which is the mutually exclusive project, means that the project will compete to each other. So only the best project, okay, the best project, okay, depends on the method that the company use in their assessment methodology, can be accepted and would be accepted lah. So say you the company using NPV. So if it is a mutually exclusive project, then we will accept the project with positive NPV and the highest positive NPV. So if company using NPV as a method of assessment, so in the case of the independent investment opportunity, it will require 2 steps. One, the company should calculate the NPV and accept the NPV that is only positive and reject the negative one. So it is quite straight to the point when it comes to independent investment opportunity. So there are 2 situations where normally companies is facing the situation where it is a mutually exclusive project. One, if they are considering a substitute, okay. So when a firm is analyzing 2 or more alternative and they want to consider the best choice, okay. The other one is when company is facing the firm constraint normally with regards to the funding available. So when company facing a funding availability scarcity, then they want, or their objectives is to invest in the best possible alternative. As I mentioned to you in the earlier slide, when you want to choose between a mutually exclusive investment and the company is using NPV, what they need to do is they will calculate the NPV, okay, and choose the one with the higher NPV. Okay, one is it must be in positive NPV, and number 2, choose the highest NPV. But this is only applicable, okay, if the company or the alternative, the investment that they are considering have equal life. Equal life means you are comparing 2 alternative. For instance, this machine you want to buy, the company want to buy, have a lifespan of 5 years. So the other alternative must also have an equal life of 5 years. So in this case, okay, you just calculate the NPV and select the alternative with the highest NPV, provided both of it is a negative a positive NPV. Okay, so if the alternative does not have an equal life, so that's why the firm must calculate the equivalent annual cost, EAC. So basically EAC is a technique that provide an estimate of the annual costs owning and operating the investment. So now, when the option, okay, when the option of the projects does not have an equal life, okay, both of the option when you calculate NPV is also giving a positive NPV, rather than just straight away choose the project with a higher NPV. Under this rule, you have to calculate the EAC. So for calculation of EAC, it will be helpful if you able to visualize it in a matter of a timeline. Okay, timeline. So basically, what the idea of EAC is like this. Okay, so let's look at this problem, a sample of problem. Okay, what is the AEC for a machine that costs 50K, require payment of 6,000 per year for maintenance and operating expenses for the last for 6 years. So this will be 6 years, 1 2 0 1 2 3 4 5 6. Okay, 6 years. So whatever is that, you may assume the discount rate is 9%. Okay, so the I is 9%. It will be discounted by using 9%. So what happens is that here you have a 50K machine cost here, and there will be a further 6K of maintenance cost. Okay, so AEC basically compare the cost of maintaining between the two alternatives. So the idea is that we want to choose the option that has the lowest maintenance cost. So what happens is that now you under EAC we calculate what is this present value of all these costs, because this is all costs. Okay, cost, because the company has to fork out their money. So calculate it here. Okay, so we get the cost amount here. The cost, indeed, this is a total cost. So the second stage is that you want to distribute all these costs into throughout the 6 years. So there are two stages. Okay, first you calculate what is the present value of all these costs here, and then distribute evenly. So evenly means you amortize or you calculate the future value interest factor annuity. Future, okay, going to zero here. It is a future value interest factor annuity. So you're talking about what is the payment every year throughout 6 years here. Throughout the 6 years. So if you are using the sample of the problem before, so this is the solution for the EAC case. So cost of the year 0 is 50K. Since the cost for each year is equal 6,000, so we can use the present value interest factor annuity. If it is not the same every year, and so you have to settle it by using multiple ways of settling it using NPV formula. So using this example, so we get negative 76K. This is the cost, the total cost during year 0. Year 0. So maintenance costs altogether will cost company 76,915. So under equivalent annual cost, so what happens is that you already calculate that the year 0 total cost will be negative 76. Okay, sorry, negative 76,915. So what happens is that if you equally distributed it throughout the 6 years, 1 2 3 4 5 6, you cannot just divide it like that. You using the 9% interest factor, so you calculate what is the annuity, the payment for this annuity amount. Okay, so you get 17k, 17k this amount. So that is the amount of the EAC. So what happened is that, remember, we are calculating EAC as an extended version of considering the NPV. In the case of you are dealing with mutually exclusive project using NPV, and the lifespan, or the time, what do you call it, the alternative, the option, both of the two option or three options is not having an equal life. So therefore you calculate EAC. So we choose the alternative that are giving us the lowest EAC, the lowest EAC. Okay, another method of assessing the project is by using profitability index. Profitability index. So profitability index is basically a cost benefit ratio equal to the present value of the investment future cash flow divided by its initial cost. So under profitability index, if PI is greater than 1, it also means that the NPV will be positive, because this is the formula of PI. PI is equal to I don't know. PI is equal to present value of its cash flow, present value of its cash flow, total of cash flow divided by initial cost. Okay, initial cost means that if this is NPV, okay, whatever is that, you calculate everything here. Okay, so that will be a total cash flow, you divide over the initial cost. That is, it's similar like profitability index. You still have to do pardon me, it is similar to net present value. Okay, net present method. The only thing is that you don't minus the amount here. You don't minus the cost minus the um, uh, total present value. Whatever is that, under profitability index, you divide the total cash flow, present value of the cash flow, divide over initial cost. Okay, so the decision criteria is, if the PI is greater than 1, automatically the NPV will be positive, then the investment will be accepted. So when PI is less than 1, then it is a bad investment, because indirectly it also shows that the companies or the project that you considering has a negative NPV. Okay, negative NPV will result PI less than 1. So the project should be rejected. So this problem is an example of how we use PI to um, assess the project viability. Okay, so what happened here is that year 0 there will be the negative cash flow, indicating the capital outlay, and there will be a series of positive cash flow in future for 6 years, um, um, indicating by all these figures. Okay, so how do we use PI as a method of assessing in the next slide? So basically what happened is that, based on the last slide, I mean the previous slide, what happened is that you already calculate um, um, the PI, what happened is that here we have a capital outlay of 50k. So what happened is that all the cash inflow in the present value is amounting to 53,600, this one. So under PI, profitability index, what happened is that you divide this figure over the cost outlay, 50k. So we have a figure that is more than 1. More than 1 means that, okay, since it's greater than 1, we're gonna accept the project. So it's basically an extension of NPV method, because as I mentioned earlier, if your NPV if you are using the NPV method and there are positive NPV, means that this capital or this expected PV will automatically more than the initial outlay. Therefore, a positive NPV will also result PI more than 1, PI more greater than 1. So far we already look at 3 methods of assessing the capex. So the next method is the IRR. The IRR. So basically IRR is similar to NPV, NPV method. Okay. The only thing is that IRR is you want to calculate what is the percentage of I that will discount all this cash flow. Okay, this is the cash flow here. Okay, what is the I that will discount all this cash flow that will result equal to the amount of outlay? Say if this company is investing 1 million here, okay, and it will provide whatever series of cash flow here. You want to, under IRR, you want to calculate what is the the interest with, okay, the YTM is similar things. What is the I here? What is the percentage here that if you discount all this cash flow, it will also give 1 million here. So your NPV become 0. This is the idea of IRR. IRR. So if you are using mathematical model to settle or to find the internal rate of return amount, so it will involve a series of try and error. But it is quite simple if you are using financial calculators or using the Excel to find the IRR. Okay, this is the last method in assessing the capex. Okay, it's a payback period. So the payback periods is the number of years needed to recover the initial cash outlay. Instead, if we have a series of inflow here, okay, we under payback period we want to look at how long it will take, okay, how long it will take for this project to cover the initial outlay here. Say it is 1 million here, how long it will take to cover 1 million. This is a very basic concept. If you are looking at a payback period, so there's some limitation for us to use a payback period. One is that it ignores the time value of money, because now you are taking the number straight away from this future inflow. So we are ignoring the time value of money. It's also ignoring the cash flow that are generated by the project beyond the end of the payback period. Say here the company is having a 1 million capital outlay. Say we have 500k here. So 500k here, inflow 500k, another 1k, 100k, 100k. So what happens is that the payback period will be 2 years, because after 2 years the company will be able to cover 1 million. So under payback or basic payback period, it will ignore the cash flow that coming after, beyond the payback period. And number 3, it utilizes an arbitrary cutoff criterion. So sometimes it's not complete. Okay, you just only focus on the payback period of the project, without considering maybe the future benefit that may come from the project itself. If we look at the project loan, so the first year there'll be a 70k positive inflow. Okay, positive inflow. Another year 2 is 30k, so on and so forth. So let's look at what happened if you are considering this project using payback period. So at the initial cash outlay at year 0, okay, cumulative cash flow is still negative 100k. So what happened is in year 1, because there are inflow of 70k, so 100,000 minus 70k, there will be still another negative capital outlay to be covered. So only during year 2 there's another cash inflow coming in, so it will equals, or it will be in the break-even state of situation. So the payback period for project loan is 2 years. Okay, what happened in the project short, it also take 2 years to cover the cost or annual the capital outlay of negative 100k. This is also 2 years. Okay, 2 years. So that is why it is sometimes as we discussed before, there's a limitation in terms of basic this payback period method, because in this case, if say the company is using 2 years as a cutoff time to accept this project, both of this project will be considered or will be approved. But if you want to if you compare project long and project short, actually project long is much more way better, because there's another positive cash flow coming in beyond the payback period. So this is as compared to project short, there's no future cash flow as soon as the company achieve its payback period. So due to the limitation of the basic payback periods, that's why we have what we call a discounted payback period. So it is actually the similar thing to payback period, but rather than you just using the amount of inflow, a basic inflow, you have to first discount, calculate the present value of that cash inflow in the future. Okay, so discounted payback period approach is similar. Okay, similar, except that it use discounted cash flow to calculate the payback period. You change you calculate what is the present value of the amount of the inflow, and then deduct it to the initial outlay. Okay, so our decision criteria accept the project if it is discounted payback period is less than the pre-specified number of years. Means that if say companies are using payback period of 3 years, whichever project that will cover their capital outlay or giving a discounted payback period less than 3 years, 3 years or less than that, then we accept the project.